You're listening to The Intellectual Investor. Episode number 41, interview with Tony Greer, Part 1, the all-terrain portfolio. To learn more about Vitaly's investing firm, IMA, go to imausa.com. Interview with Tony Greer, Part 1, the all-terrain portfolio. In early November 2019, I sat down with Tony Greer of TG Macro for an interview to be featured on Real Vision, a widely respected financial thought leadership network. Tony and I discussed how we construct an all-terrain portfolio at IMA and the role that the macroeconomy plays in investing. We also touched on topics such as negative interest rates, gold, and oil. I hope you enjoyed this conversation as much as I did.
I'm Tony Greer, editor of the Morning Navigator newsletter. I'm excited for my conversation today with my friend Vitaliy Katzenelson. He's a die-hard value investor. He's a published author and CEO of Denver-based investment firm IMA. Vitaliy, how are you today?
It's my pleasure. Great, thank you.
Good, man. Thanks for joining us today. I appreciate it. I was first drawn to your work of your market analysis by the metaphors that you use to music and art. I started reading your newsletter, and I love that you open up every day, usually with something sort of, mind expanding and not drilling right down into the markets. How do you come up with the metaphors? How does the art relate to the market so easily for you?
Well, I spend a lot of time in the morning sitting in a dark room, staring at the computer, and it's almost like meditation in itself.
Yeah.
You always try, when you write, you try to find a way to explain something that is complex in an easy way, and metaphors are usually a way to do this. And then I love art, I love classical music, and so life is too short if I just write about investing.
Yeah, so. That's so true. I couldn't agree more. Sometimes when you see something in the markets, it becomes naturally in your head, and you're like, oh, that's just like a song, or it reminds me of a painting.
So you know what happens, actually, it's kind of interesting. So if you write, and I write every day for an hour and a half a day. If you write, you start thinking like a writer. And what I mean by this, you start looking for metaphors. Actually, this is a perfect analogy. So I live in Denver, and 100 miles away from a lot of ski resorts. Mm-hmm. And I skied for a long time, and I thought I was a good skier. And I thought I was a good skier because we skied in Keystone, where the mountains, it's a relatively small resort, and the mountain is perfectly groomed. Mm. I was always the first one down the mountain, and I felt like I'm a very good skier. And then one day we went to Vail, and it snowed a lot. The snow was very deep, and it was horrible. And I would fall like every 5 minutes, and I hurt my shoulder actually. So how does it relate to the market? So here is an analogy. If you were investing in the market over the last 10 years, then basically Federal Reserve basically groomed the slopes. You're skiing in Keystone. So you think you have a great, perfect form, etc. Except this is not the real market. At some point, we're going to have a real market, and it's going to snow a lot, and you're going to find out that you are probably not as good of an investor as you thought you were, just because the slopes would not be perfectly groomed.
That's right.
So that's like.
Great.
That is an analogy.
Perfect
right
analogy, right? You open somebody's eyes with just such a simple story, and it relates directly to the markets.
Yeah.
So now let me ask you another question, Vitaliy. How were you so inspired by the financial markets? When did they finally become something in your life that you decided, okay, this is something that I want to do and pursue?
So I grew up in Russia, in Soviet Russia, not just Russia, Soviet Russia. So I knew very little about financial markets. When I thought about investing, my images would be very close to the traded places when they were trading, orange futures or whatever. So I always thought investing is basically a lot of people yelling at New York Stock Exchange. That's what I thought investing was. Yeah. So when I came to the United States, I was very good with computers. I knew nothing about investing. And I was going through majors in college, like Dean Martin was going through girlfriends. How's that?
Yeah, good, perfect. Keep the analogies coming. I get those.
But anyway, and then I got a job with an investment firm. They hired me because I was good with computers. And they had a Bloomberg terminal, and I started talking to other portfolio managers, and I realized, my God, this is what I want to do. Yeah. So at that point, my life became much simpler because I realized I changed my major for the last time to finance. And that was it.
It's amazing. I find it amazing that you pivoted toward finance and decided that your life became much simpler.
Well, because at this point I knew, once you have a focus, right, then
you can become more single-minded about your career.
Exactly.
Totally. Very cool. So along the lines of the awesome metaphors that you construct, I was listening to a podcast that you did that I really enjoyed, where you went over your sort of all-terrain portfolio. Tell me a little bit about that, because I think that our audience would appreciate it.
So to talk about all-terrain portfolio, we kind of got to talk about the macro picture a little bit. So if you look at the economy, not just U.S. economy, but global economy, you'll realize that if you look at the U.S., our market, our debt has doubled over the last 10 years, and interest rates are lower probably now than they were 10 years ago, or close to that. So if you look at Europe, the picture is very similar, except you have a union of you have kind of a dysfunctional marriage, of a lot of countries. So it's not just it's a very big dysfunctional marriage. And then you look at China, and you see that this is an enormous bubble, which it's been going on for so long. It's like you don't want to talk about it anymore, because it's but it's an enormous bubble. You have a huge overcapacity. The debt probably quadrupled over the last 10 years. And then you look at Japan, and Japan is basically the most indebted nation in the world. In a first world country, at least, the population is shrinking, and if you look, so debt per capita actually is growing at a faster rate than debt per GDP. So macro picture overall is not great. To make things even more interesting, you have a rise of nationalism, which we're seeing today, and so that's a kind of a very tepid macro picture. And then you look at the valuation of U.S. market, and we basically, it rivals today valuation of 1999 or 1929. So the stocks are expensive. So this is the terrain we have in front of us, right? So how does one construct a portfolio for that? You basically want to own companies as if things hit the fan, basically. So let's go back to the analogies, right? So if you own like a Range Rover or Jeep, over the last 10 years, probably did not benefit you, because you were bid by very fast cars like Ferraris, etc. Okay, Ferrari is great when you have this perfectly paved road. The problem is that's not the road most likely going to be ahead of us. So therefore, you want to own stocks that can get through this. So what are those stocks? Companies that have significant competitive advantage, that basically high quality companies, significant competitive advantage, high recurrence of revenue, very little debt, whose business is very is non-cyclical or not tied to health of the economy overall.
So we're going bottom up, right? Looking for the companies from bottom up rather than top down, trying to decide what sectors we should play.
So it's kind of interesting. So you're absolutely right, but investing is not. So when somebody asks me, are you a top-down investor or a bottom-up investor, I would quote, I think somebody who said it, I'm going blank on the name, who said, we worry top-down and we invest bottom-up. So all the things they describe about the global economy, you have to be aware of them if you're a bottom-up investor. Because when you value a company, the value of any asset is the present value of its future cash flow. So you can't really do analysis into the future cash flows and not be aware of factors that may influence them. So as a bottom-up investor, you can't just be ignorant about what's going on around you anymore. It's kind of interesting. In the past, before 2008, value investors were very proud that we said we don't worry about economy. We don't worry about
agnostic.
And I think there were a lot of them got that idea from Warren Buffett, where Warren Buffett said, "I don't care what Federal Reserve will do next month," except they misunderstood Buffett. What Buffett said, he doesn't care about short term, but it doesn't mean he doesn't care about long term. Okay, so you have to be. So the way I look at the macro forecasting for value investor, you basically don't want to worry about weather, because if you try to predict the weather, which in my mind would be trying to predict what Federal Reserve will do next 3 months or 6 months, you will spend a huge amount of energy into something that has a very short-term shelf life, because you have to keep doing it every 3 months. Okay. However, as a value investor, you want to be looking for climate changing events. Like you want to be a climatologist, looking for big shifts that may impact you in the long run.
Yeah, I like that.
So if, I'll give you just one example. But if you look at China, for instance, And if you ignored what's going on in China, you would have you basically would have probably overexposed to commodities.
Yeah.
Okay. Because China, it was the largest incremental consumer of commodities, right? So then you would have been annihilated in commodities. Right. So as a value investor, as an investor, we looked at what's going on in China, and I spent a lot of time talking about it, and then we avoided the carnage that came from commodities, as an example.
Right. No, that's very smart. It's very smart. While you're going over this, I'm trying to go over my portfolio to decide if I have enough rough terrain stocks in it. Mm-hmm. So can we talk about some of the stocks that you think will make it through? Like in my mind, I'm going through names that are like, I'm trying to pick out refineries or tech companies that I think that are going to be, not as affected by, an economic slowdown or things like that, or maybe an industrial company that sells razor blades is going to be safe through a pullback in an economic recession. What kind of companies do you want to buy?
We have a lot of exposure to healthcare. And if you look at healthcare, so the famous bank robber who said, why do you rob banks? When he asked, why do you rob banks? He said, that's where the money is.
Yeah.
So as a value investor, we gravitated towards the healthcare companies because that's the sector that checks off a lot of boxes.
Yeah, constant cash flow.
Yeah,
right?
it's a rise in demand. You have you have very predictable cash flows. You have a pricing power. And you have, for the most part, very good balance sheets, which is very important. And one factor we haven't discussed yet, they have very compelling valuations because as a sector overall, and it's probably one of the cheapest sectors today, and outside of maybe oil stocks or something. Mm-hmm. But that's probably one of the most attractive sectors overall, and that we have a lot of exposure to that.
Really interesting. I like it. Is there a place for commodities in your portfolio?
When you talk about commodities, let's break them up into two.
Let's do that.
Yeah.
I can break them up into individuals if you want. We have time.
No, but to me, it's like you have industrial commodities and you have precious metals.
Fair.
So two different commodities.
Let's start with precious metals.
So that would be gold.
Gold and silver.
Gold and silver. And I probably would put silver somewhere in between because it's half precious, half of it is used for
partially industrial.
Yeah.
Partially precious.
Gold is a lot more. So if you and I talked 10 years ago, here's what I would have told you. I said gold to me is investable, and here's why. As a value investor, it's very important for me to be rational. The way I can be rational, when I analyze the company, I get a fairly good idea how much it's worth. Mm-hmm. When you and I can have a debate how much Microsoft's worth, etc., and we're going to have a range,
Fair.
Okay. With gold, it's very difficult to have this debate because it has no cash flows. It has a cost of carry. If you actually own physical gold and you put it in the bank,
storage.
There's storage cost, right? So I would have told you that gold is not something that value investment, I would own. Today, we still don't own gold, but I'm gradually warming up to it, and here's why. We live in a world today where $17 trillion of debt has negative interest rate. Like the words negative interest rate, I don't even understand what it means. Yeah. Like it's like something like
if you like an oxymoron.
It is an oxymoron.
Right?
Yes, exactly. Because if I give you $100 and you pay me back $90, we would call it a default. Not in
right. No, it's true.
Not a negative
Such a great
rate.
point. The market's trying to figure out exactly what it is, in my opinion, and I don't think anybody has the answer.
That's right. And what's interesting about this, that in the past, our U.S. policy was we want to have a stronger dollar. Today, we are literally trying to compete with other countries that have either zero interest rates or negative interest rates to drive our interest rates down. Mm-hmm. So we basically operate, we are kind of going towards the command-controlled economy of Soviet Russia, where the most important commodity in the world, which is price of money, is set by central bankers.
Right.
So and therefore, when you do this, you lose signaling. The markets are losing signal mechanism. Mm-hmm. Okay, because there is a reason why market forces set price for commodities or whatever goods.
Yep.
Because if there's too much demand for it and the price goes up, to produce more. Okay.
Right. The signals. Yeah.
Yeah, that's right. And that signaling mechanism has been damaged by central bankers today. So we are in a world where you have negative interest rates. So suddenly gold does not sound as crazy anymore. Okay. So to be fair, we don't own gold yet, and we're still trying to figure out what's the best way to invest in gold.
Yeah.
Do we want to actually, buy an ETF? There are other alternatives. Let's talk about that's one precious metal. Mm-hmm. That's when you talk about industrial commodities, it becomes more difficult to me, because for the most part, their price is set by the supply and demand. And if you're concerned about the health of global economy, then you understand where the problems with future demand may be, and especially problems with China. So usually these companies, and I'm generalizing right now, are not very good businesses. Usually a lot of debt, very cyclical, low return on capital. So
dangerous mining operations. There's all kinds of hurdles for base metals. Not to mention that sometimes they go off in different directions. Like now we've got the price of nickel rallying because of what's going on in Indonesia, and generally copper and aluminum are just getting hit right now with fears of demand destruction. So they're a little bit difficult to keep track on. What about oil? Before we leave the commodity space, I want to know if you have a strong view there, because I'm starting to develop.
Yeah, so the oil, and if we have no exposure to it today, but in the short run, I would say probably I would be bullish, and then in the long run, I'm bearish. And the only reason I'm bullish, in the short run, just because price of oil was very low for a while, and that probably destroyed a lot of supply. And so again, this is a generalist, kind of
totally fair.
When you've seen the cycles before, and this may open up a big can of worms. But in the long run, I think electric vehicles are the future, and therefore, that's a big headwind for the oil industry.
In the long run, I would tend to agree that is going to be a headwind, but I'm also, like you, I'm very bullish in the short run because the geopolitical situation is changing so dramatically right now that I just think the risk premium on oil is too low. But that's something that we can argue about forever, because I've just been trying to express it by being long oil volatility, because it's been gyrating so aggressively back and forth. So we don't have to pick a direction on that now. This does probably relate to another research project that you've worked very diligently on when you say electric cars are the future. So tell me what you think about, we should get a drum roll or something here, but I would love to hear what you think about Tesla.
Okay, so there's a preface to the story.
Go ahead.
Stay tuned for part 2 of my conversation with Tony in episode 42. Thank you for listening. This and other investment articles by Vitaliy Katzenelson are based on value investing principles that were first brought down from the mountain by Benjamin Graham and later were popularized by Warren Buffett. To learn more about these principles, visit investor.fm and listen to the first episode of this podcast, titled The 6 Commandments of Value Investing. To learn more about how Vitaliy's investment firm uses these principles to create low-risk, long-term oriented portfolios, visit imausa.com. Enjoy life and prosper.